Hello, this is Oscar, the lead analyst at Binarium. In this video, we'll talk about technical analysis patterns. I'll demonstrate examples how to identify such patterns on a price chart using graphical tools. First, let's recall the three axioms of technical analysis. The first axiom is all factors affect market movement. The second is price movement has direction, and the third is history repeats itself. Price chart patterns adhere to the third axiom. History repeats itself. This means that if you see a certain pattern on a price chart during analysis, it will inevitably occur again. This forms a pattern that can be used to find entry points into the market. Technical analysis patterns can be divided into two groups, reversal patterns and continuation patterns. The names of these groups speak for themselves. Reversal patterns indicate a significant change in the dynamics of the existing trend, and continuation patterns indicate a pause in the market. Perhaps the trend was developing too quickly and temporarily entered a waiting state. Let's start from reversal patterns. This group includes the head and shoulders pattern. It is one of the most reliable patterns in graphical analysis. It forms at the end of an uptrend and consists of three consecutive peaks. The first and third peaks are roughly at the same level, forming the shoulders, while the second peak rises above them. This is the head of the pattern. All three peaks rest on a single support line, commonly referred to as the neckline. Let's go over how to find the head and shoulders pattern. For convenience, let's use the line segment tool. You can find it in the graphical tools menu at the bottom left corner of the terminal. Now, we need to find three peaks on the chart, where the first and third peaks are below the second one. In this case, I'm clicking the red arrow button pointing down, indicating a forecast for a decrease. The expiration time is minimal since the pattern was identified on the smallest period. In practice, technical analysis patterns may differ from perfectly smooth and clear patterns from educational examples. That's okay. The head and shoulders pattern generates a signal for a decrease after the chart breaks the neckline and then returns to it. Preparation for entering a trade can be done after the completion of the formation of the second shoulder when the price starts moving towards the support level. Meanwhile, the trade has ended. We see the profit being fixed. Another group of reversal patterns we'll look at are the double top, double bottom, and failed swing. These technical analysis patterns are quite common. After the head and shoulders pattern, they are the most prevalent and recognizable. In the upper left part of the screen, you see the double top pattern, while in the lower right part of the screen, you see the double bottom pattern. The double top, similar to the head and shoulders pattern, signals a decrease. Overall, they have similar characteristics, except for the number of peaks. In this pattern, there are two peaks. There's also the failed swing pattern. It visually resembles the double top pattern. The key difference is that the second peak of the failed swing is noticeably lower than the previous one. Let's see how the double top pattern can appear on a real price chart. First, we need to identify the peaks. Using the line segment graphical tool, we highlight the two peaks of the pattern. They should be the same height, but sometimes the second peak may be lower than the first one. In this case, we're dealing with a failed swing. The minimum level to which the price chart can drop after the breakout is determined based on the height of the pattern. To do this, we use the line segment tool to measure the distance from the peak to the support level and plot it downwards from the breakout point. A signal to open a trade is the chart breaking the support line. As seen in the video, a forecast for a price decrease is made after such a signal. As with the previous pattern, I chose the minimum expiration time since the pattern was identified on the smallest period. Sometimes, after breaking out, the price chart returns to the support level and then bounces down. This could be a signal to reopen the trade. The forecast was successful. Profit has been credited to the account. Let's move on to the second group of technical analysis patterns, namely to the continuation patterns, Flag and Pennant. These patterns indicate short pauses in a dynamically developing trend. Flag and pennant are formed after an impulse movement of the price. On the chart, it appears as an almost straight line. This is the flagpole of our flag. The flag itself on the chart often appears as a parallelogram at an angle. Breaking above the upper boundary signals an increase. In technical analysis, flags and pennants are considered the most reliable continuation patterns because reversals on these patterns are extremely rare. The pennant pattern is formed by two converging lines, which together with the impulse line form a triangle. The pennant is often positioned more horizontally than the flag, but there are exceptions, of course. The methods of measuring both patterns are quite similar. Flag and pennant literally replicate the previous upward movement of the chart. In other words, after the breakout, a line is formed that repeats the flagpole of the pattern. Let's move on to examples. First, we need to identify on the chart a consolidated price movement that begins immediately after a sharp rise. Such a movement can form either a flag or a pennant. On this chart, we can see that the upward trend continues. The consolidation of movement in the form of a flag or a pennant indicates a pause and weakness in trading. Often the pause occurs because market participants are taking profit from previously acquired positions. Sales may be small because traders expect a new wave of growth. Such a situation may indicate that market participants are ready to continue buying this asset. A strong signal to enter a trade will be the breakout above the upper boundary of the flag or pennant pattern. After that, the price starts moving in the opposite direction to the slope of the pattern. If you prefer a more conservative approach, you can wait for some time to ensure that the pattern has formed properly. Meanwhile, on the chart, we can see that traders are willing to buy the asset further. The breakout from consolidation gave a strong signal for an increase. The trade was closed with a profit. That's all. Use the information from the video to understand the chart and improve your trading efficiency.